Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Mr. Michael Becker is on another due diligence assignment. So we have the professor in again today, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
So, success has many fathers, I would think. And you and our guest today have had success together at a company you guys used to work for. And I would think you guys kind of are a little bit of a tag team that somebody wanted to get into real estate and somebody wanted to get into financing, and you guys kind of have helped each other over a period of years. And so in the podcast today, we have some of our friends that we've just closed another transaction with that tell a great story. And I think you'll really enjoy this story because I always do. I always enjoy good stories. And so we're going to talk to a couple folks that I think are going to be very interesting that I think you'll appreciate the time you've spent in this podcast. So I'm going to kick it over to James. And James, let's go with the introductions.
Yeah. So James Eng here with Old Capital. And today we have Jeremy Thomason and Prasad Chawla. And I'll tell the story. I thought it was unique in that I saw an article last night on LinkedIn and they called it the Ge Mafia. And basically when GE breaks up some of these companies or sells some of these companies, the people who leave GE go on to bigger and better things sometimes. And they're leading technology companies. They're leading a bunch of different industries. So Jeremy and I worked at GE together. I mean, maybe Jeremy, kick it off and tell people a little bit about your background before you got to GE, and then we'll dive into some of these deals that you recently completed.
That's great. Thanks, James. So yes, I am a proud Texan that went to Texas A&M. And right out of school, in the middle of the 90s when I graduated, I went to work in commercial banking. It was actually a niche inside of it, equipment leasing, and started out with a company that was later acquired by Citibank. And then our division was sold in 2008, 45 days before the Lehman Brothers imbroglio to Ge Capital. And I was started out in risk and leading sales teams, origination teams in various roles and responsibilities along the way. And it was during that tenure, I'm not exactly sure when, but probably 2010, 11 timeframe is when I met James. We didn't work in the same division. So I'm thinking it was one of the different type of affinity groups that at GE that they really promoted, that we got connected and hit it off. Even though I went to A&M and he went to Texas, that can actually coexist. Became friends. I was always really passionate about real estate. James worked in Ge Capital Real Estate. And for those that may not remember, they were one of the biggest players there was globally in really all forms of real estate. And James was on the risk side. And I was just fascinated by it, even though I was in sales and origination. I'm a finance person, finance MBA, and just wanted to start learning about it and really hit it off with James. And he actually would start giving me deals that they had already done at GE, so I could actually underwrite them myself, just learn about it. Started out in self-storage, just trying to understand that space, was fascinated by it. And it quickly morphed into multifamily. So that really was the beginning of the relationship at Ge Capital from James and I. We weren't certainly doing business together or anything like that. We were just friends working together for the same greater good of driving profitability for Ge Capital and General Electric. I'll just finish that bit of the story there for a second while we're on it. So again, in about 2012, 13, GE started having problems, and it became clear that being regulated by the Federal Reserve was not the place that GE wanted to be. And so they started de-emphasizing Ge Capital. And really in 2015, they put a for sale sign out and wanted to divest all of Ge Capital. And really it was at that point that James and I, in separate transactions, left GE Capital. James's division was sold as a non-going concern, an asset sale, and so James didn't have a job. And thankfully for that he landed at Old Capital. But for me, I landed at Wells Fargo in a going concern. And so we remained friends, but it was during that time that James introduced me to what I call he's a crack dealer. And I say that with a very, very amorous type, I guess, lens, because he introduced me to the idea of syndications and investing in multifamily. And it was a mutual GE Capital guy that he had gotten connected with. And really, that was the beginning of the story. So I'll stop there for a second, but that's sort of the preamble to how I got to multifamily. And that was about 2015 or so, whenever that was introduced. I'd already been investing in single family stuff, as so many people do, and decided to give it a spin on the scalable side of multifamily as a limited partner.
Well, Jeremy, it's been a hell of a journey, and I think we've done, 400 or 500 of these episodes, Paul. It feels like 400 or 500 episodes. And Now, Jeremy, you probably have listened to almost every single one of them, and you are on it. So thank you for being here. And let's jump over to Prasad. Prasad, I guess, where does your path intersect with Jeremy? And then we'll jump into some of the deals that you guys have done so far.
Sure. Little about myself before I give an update on how JT and I met. I'm a technology executive on a W-2 basis. That's a full-time job still. Like you mentioned, James, at some point, we want to do real estate full-time, right? All of us do. So looking forward for that day. From a real estate journey perspective, we started in 2011 I started in 2011 on the single family space. But in 2018, that's about an year into JT and I met, and we started working together at CoreLogic. JT actually introduced me to this concept of multifamily investments. I was very fascinated about the concept of how people can come together, form a team, and really go achieve something that you can't do on the other spaces, right? Multifamily does provide that kind of an opportunity. So very excited with the whole idea. I started actually looking for opportunities where I could invest passively. And JT and I, within about 2 months of the first introduction to multifamily, invested together on a deal in Dallas. JT and I continue to work on the same company. He runs sales for a division that I run technology. So we do have a lot of time together, both from a real estate journey as well as from the W-2 jobs as well. So there's a lot of cross connection going on there.
Maybe let's talk. I mean, a lot of people have great plans they start as a limited partner and they want to move over to the general partnership side. Let's get into the first deal and talk about Monterey, which you guys did at the beginning of 2020, and talk about was that the first deal you looked at? How many deals did you look at before then? What was sort of that process? Because I think there is a big hill that people have to go from 0 to 1, and talk about running up that hill for us.
Yeah, I'll start, and then and Prasad's got a great way to finish on the Monterey story. So this is a little bit back to James, and so I had at that point invested in 15 probably deals as a limited partner. Where we work, I'm blessed. I was recruited away from Wells Fargo, so I got sold to Wells Fargo. It was fine, but it was not a great culture fit for GE people at Wells Fargo. Very different cultures. And I was recruited away to come to CoreLogic to run a division called Rental Property Solutions, run the sales team for it. So we sell software and data into the multifamily world. And that was a real blessing for me, because now my W-2 life is in multifamily. I was getting paid to go to conferences that I would pay to go to if I was just out there. So it was a really great synergistic way for me to delve in and really start learning, not just as an LP, but also as a supplier in the space, which isn't a story that I hear a lot on the podcast. Usually you hear about people hating their jobs and wanting to retire early and using passive incomes. There's other ways to do it. I mean, Michael Becker is the classic case of taking the industry, the service providers in the industry, and then taking that knowledge into the actual ownership side. So James and I had talked a few years ago that said, at some point JT, everybody calls me JT, is like, you're going to have to scratch that itch that is being a sponsor on a deal, or at least being a KP on a deal. And I had that as a goal. And through James, I was introduced to various sponsors and ended up being chosen to KP on another deal with another group that's been on your podcast before, great friends. And that was a great evolution in the journey. And then Prasad had come to me in the meantime and said, look, we need to do this. We need to go out and find a deal for ourselves. And I told him, Prasad, I don't have the bandwidth. There's a lot that goes into being a GP. And Prasad knew that too. He'd been in mentoring groups, and he's like, I know what you can do. I know what you do well. I know what I do well. We have another group or another husband-wife couple, and we want to join together and form a team. And I said, you know what? That sounds great, because I only have this amount of bandwidth, and this is a team sport, and I can do certain things really well, and they can do certain things really well. We all can do all things, but nobody has bandwidth to do all things. And so that was an important part of the early stage of Monterey, because really at that point, when we decided to do that almost 2 years ago, was really when we said, okay, now let's figure out what we go after. And that's an important part for newbies, is trying to figure out what your filters are. Are you thinking about the whole United States? Are you thinking about Texas? Are you thinking about DFW? Are you thinking about A class, B class, C class, all these different filters to allow us to narrow down to a space? And we pretty quickly decided that, hey, our initial filter was going to be $5 to $15 million on deal size. We wanted to be professionally managed. So we needed a unit count that probably was over 75 units. And it was the classic value add hybrid play. So cash flowing property that had some value add needs, go increase value, 3 to 5 year pro forma syndicated deal. That's what we sort of landed on within sort of the drivable quadrant of DFW. And so we started. And I don't know how many we actually looked at. We underwrote a dozen or more, like fully underwrote. Started the LOI. That was a little bit scary to just actually do an LOI for the first time, but got over that pretty quickly. And then with Monterey, we submitted an LOI and we didn't win it. And that happens a lot in this space. And so it was interesting, because we were I was at the National Multifamily Housing Council event that was in Dallas, the Anatole, called OpTech. And because it was a local event, Prasad came over. And I just remember distinctly him saying, this is about 3 weeks after we were not awarded Monterey. He was very polite. I was talking to some customer and doing my thing in sales, and he started pulling my jacket. And he's like, after 10 minutes of him just standing there politely, and I was like, what do you want? And he's like, I just got a call. The broker on Monterey called and said they're having problems. They can't get into a PSA, and they want to know if we're willing to take a shot. And I said, well, yeah. And so, quickly finished up my conversation. And, while we were at that conference that day, we basically agreed in principle to a deal. So sometimes finishing second is really finishing first, because you never know what kind of drama is going to end up happening with whoever gets awarded the deal initially.
Yeah, I mean, I think our buddy who used to work at GE, he said he has never won a deal. He has almost always come in second, and almost every deal it's come back around. So sometimes you have to be patient.
Prasad, what is your take on that conversation you had with JT and just some of the facts around it?
Yes, I think before the conversation, just want you guys to know that important for us to take some time and really form a team that can be with you in every step of the process, right? I am really blessed to be partnering with JT, the Madhuris, and on any deal that we're doing. The sense of a team and the ability for each of us to fill somebody else's shoes actually really makes you very strong, right? In addition to that, when you have people like James Young, people like the other vendors that we really partner with, once we've created our team, we started partnering with them and started to improve started to put our brand value out there. Those endorsements help quite a bit in getting a deal. Now, the conversation with JT was like, JT, come on, man, we've got much better news here. Can we have this conversation, right? And that's in my mind. But as we all know, W-2 commitments are equally important as well. So I really waited for an opportunity where I could talk to JT. We then, after the initial, whisper, we actually decided to come out of the conference, sit down, really calmly and think about the pros and cons of where we are getting to. And it did not take us more than about 5 to 7 minutes, JT, please correct me if I'm wrong, for us to determine that, yes, this is a go for us. Let us actually start thinking about moving forward. Then we divided and started conquering this. Ravi, who's one of our other partners, started working with the broker while I'm trying to actually put down my numbers together. Numbers crunching is what I do most of the time. So I started looking into that while JT had a conversation with James and to really run this idea, right? And in the next 15 minutes, we're calling the broker and saying that we are in. We would like to move forward. And the rest is history.
So before we get into the rest of this history, really quickly, what would you say, what were some of the sort of key takeaways from that first transaction? I know it was about 105 unit deal in Fort Worth. Paint us a picture for the people who are listening of sort of what that deal looks like. And then what you guys like about that deal besides winning it, obviously, but what do you like about the deal? And you guys have owned it for about a year now. So give us a little bit about managing in this COVID cycle right now.
Yeah, so we closed on January 24th, 2020. At that point, if anybody was talking about COVID, it was sort of in the peripheral news. If you just remember your timeline of when all of that really started going down. So COVID wasn't really a concern at all at that point in time. I mean, I had just gone to the NMHC annual event, which is, if you've been to that thing, that's like a sweatshop of people together. I mean, just jammed together. It's like if there was a super spreader there, that would have been horrible. That's how jammed it was. And that's where we were. And so the Fannies and Freddies of the world, they were all still lending. Everything was fine on January 24th. What attracted us to the deal was it fit all of our filters first. So it wasn't a deal that we were too worried about. The equity raise, we needed to raise about $3.3 million on that. And that was a typical sort of friends and family raise from the three main partners that we were able to do. And so that was an important factor for us. There was definitely value add plays, multiple value add plays. We knew that the existing property management company, so shout out to Citygate, they were managing it, and they are who we had chosen. One of our key vendor partners was Citygate. And so they had a lot of insight about the property. And what we could see is that at renewal on all these leases, that they were increasing rents by 5%, 6%, without really any problem, high occupancy, and without any problems in place. And so we knew that, we had a couple of different sort of relief valves on our pro forma that were, hey, we know that a lot of the units haven't really been upgraded in a while. This property is about 50 years old, and it's a real strong sense of community. It wasn't too big for us as a first deal to take down. It was $9.5 million purchase price. And all of those things came together, and we knew that we had opportunities for value add with some of the traditional sort of value add plays. But we also knew that the in-place rents were sort of underperforming where they could have been. And Citygate pretty much told us this, is like, we know we can bump rates. So there was a bunch of different areas that we felt good about. Not all of them are ever going to hit, but we felt like that we had a lot of them in case one or two or three of them didn't work. Now, none of us could anticipate what was about to happen 6 weeks from there. And without saying too much about that, we know that our deal would not have closed if the date had been March 24th and instead of January 24th, because everything stopped, as you guys well know, by March 24th in the space. And so we felt very fortunate to get the deal done, up and running, sort of digested, onboarded, those kind of things, and up and running before sort of all hell broke loose with all of the COVID issues mid-March.
Well, Jeremy, it would have closed. You would have just had to bring an extra $700,000 to put in your COVID reserve. So it would have closed. Prasad, maybe we'll jump over to you. And now that sitting here a year later, what do you think is like one thing that you have learned or that you wish you knew a year ago before you bought the property?
It's a tough question when you have an asset that's really performing very well. I think if we had the relationships, like, as with anything in life, right? As you mature in a business, you tend to form a lot of great relationships. If we knew that, while we were closing, I think we would have done much better than what we did in the last year or so, right? Having said that, I want everybody that's listening to know that we feel quite fortunate to have Monterey as our first deal, because it's really, during these tough times also, the asset has really performed very well. We were able to hit everything in terms of our KPIs that we've established for the year one. So I think overall, Monterey experience is something pleasant as a first timer, and which encouraged us to go to the second and the third deals.
So let's talk about the second and third deals. So you hit 2 and 3, I guess we'll call it, but it was a portfolio. So maybe talk about how the second deal came up. And I guess on the second deal, you knew COVID was coming. It was already here. So how did you guys structure that one, whether it was the same, different, and talk through that transaction?
Yeah, so I'll start. I think it's important to realize that, the comments you made about, the extra COVID reserves in order to keep liquidity going. Now, at this point, we're in the fourth quarter of 2020, and those rules had sort of been established. And so you could underwrite with the expectation that there was going to have to be some extra reserves just put up, whether that's right, wrong. I mean, all of us would probably say it doesn't really work the way they intended it, but the reality is they're the bankers, and if you're on an agency deal, then that's the way it's got to be. We were really focused on a couple of things. Number one, because I work in the multifamily world, and what we really do is we're really big on risk mitigation, especially tenant risk mitigation. We're one of the largest screening providers that there is. I have a real in-depth knowledge of rent performance, rent rates, risk, all of the things around that. And that's an unusual place to be for even the most savvy sponsors. They just don't live and breathe screening and evictions and all those things. And if you think about it, that's the heart of what COVID was. We were all worried about, is that rent was going to just fall off. And so I feel like that we've got probably as good a lens as you can have in this space, recognizing there's a bunch of unknowns, to anticipate what is going to happen with rent relief, stimulus, all of the different things that have been coming up. I have to do that in my day-to-day job. And so that I think gave our investors some confidence that, hey, what about COVID? What's happening with COVID? And our performance in Monterey had certainly indicated we really didn't have any issues whatsoever. So we were on that front a little bit, I think, probably more confident than some people had been. But I think as we got to the fourth quarter, we realized that this fear that we were having as an industry around getting deals done wasn't warranted as much as we all thought it might have been back in April. If you listen to your podcast in April, I mean, the world, the sky's falling, right? And by the time we got to the fourth quarter, the brokers had all started releasing deals, and there was a ton of deals that were being released in September and October, as you guys well know. But we also knew that there was administration change that was likely coming. And some of the great things about the current tax laws is bonus depreciation. And so we knew we needed to get a deal done and closed in the fourth quarter. And in order to do that, we had to get the deal pretty much, under contract by August or October 1st. I mean, you really need to have about 90 days, especially when you talk about holidays. And so we were really focused on finding a deal. We'd actually added a couple of additional GPs to our team that had some more liquidity and balance sheet to allow us to expand that 5 to 15 window up to, say, 30. And then this deal came along. We were underwriting like crazy, touring like crazy, submitting LOIs like crazy. And this deal came along. And what we'd learned by finishing second 3 or 4 times, or at least invest in final, was that you don't have to wait for the call for offers to get your deal in. In fact, if you do, you're probably going to lose because somebody is going to come in and preempt. And so we learned our lesson sort of the hard way. And so we called the broker up right as we saw this deal and said, hey, we're interested. We can make an offer that is at whisper or above. We can go hard, pretty heavy, day one. And we can close in 2020. And we want to get this thing tied up 2 weeks before the call for offers deadline. And that was really, if I pointed to any one thing, it was that ability to get the deal done, because by the time the call for offers came, I don't know how many you probably do, but there was probably at least a dozen offers from well-qualified groups, but we'd already got it tied up by the time that I guess that point in time came.
Yeah, it was a very interesting time in that for the amount of deals that were out, you would think, why doesn't everybody wait? But everyone sees the clock ticking, the election coming, interest rates, who knows where they go. And all of a sudden, the deal that I wanted to sell in 2020, I've been waiting 6 months because March, April, May, I couldn't sell anything. I've been waiting 6 months to get this thing sold. And now I'm out of time. So I got to go. And so you saw sellers taking deals early, offers early. And so that was the right strategy at the right time. Every deal that I've seen come out this year, it's been different. They're like, we're in no rush. We're going to wait until the bloody end and have people fight it out. Best and final, the best and final. So maybe Prasad, jump in here. So you guys get under contract on the deal. Talk to me about sort of, all right, for the next 60 days, what goes on in your head?
Yes, I think especially on this portfolio deal, right? From the time we got our PSA to the time that we had in hand to close, it was barely about 60 days, right? Your normal cycle is about 90 days, and then you have a couple of extensions built into it. Although our contract actually gave us a 60 days instead of regular 90 days, we didn't have the leverage to, or the flexibility or the luxury to extend that into the first extension or the second extension because of bonus depreciation that JT talked about. So this one actually think about doing everything from an acquisition perspective on a fast track. It was exciting. Sometimes it was nervous, but I think when you have the right team and the right people like yourself, James, in your team, we could execute this. We've shown this with this portfolio. It was a big deal, but still, as a team and the extended team, we were able to achieve this.
So I'll go back to Monterey real quick. So on that one, you guys did a Fannie Mae loan on that, and then this one was a Fannie Mae loan. And maybe talk about why a lot of people were going sort of Freddie floater on transactions, sort of Q3, Q4. What were the thoughts on Fannie versus Freddie on the second deal?
Obviously, the answer to the leading question, but so we were in the Freddie floater camp too. It just made too much sense with where the caps cost. And, we have a value add strategy here. This is an older asset, or both assets are older, Irving, workforce housing, lots of value add plays. So if we execute things and don't have some sort of COVID sort of resurgence or vaccines don't work or something big macro black swan kind of event, we could be ready 3 years in to turn the asset. We do a 5-year pro forma, and the yield maintenance with the fixed term debt is always sort of on our mind. And so we like the flexibility of the Freddie floater with an interest rate cap, and we were planning to do that. But as you and I discussed, you astutely from the beginning say, I like that play, but you need to know that Freddie in particular is getting flooded. And I don't know if they have the ability to get this deal done. And you were on us like crazy to get the deal, just the milestones going. And I feel like we were doing our part, but it was a tricky thing because we were working with the broker who has in-house finance, but we wanted James to be involved because he's a valuable part of our team, and we structured a way for that to work for everybody, and that worked really well for James to be a key consultant on this deal and to receive the remuneration that was fair and how we did this. We talked a lot. It's like, we just got to get going because we don't know what's going to happen. Well, we were at the point of, I guess, getting the deal submitted to Freddie. I don't remember that week, but that week, and effectively what had happened about 3 days before, Freddie had signaled to everybody that if you don't have your app in, then you're not closing in 2020.
Yeah, it was like backdating. They were just like, all right, well, today's Monday, but if you weren't in by last Friday, then you're done for this year. So that essentially was the first week of October. And so I think you guys signed the PSA sort of mid-September. And so we had about 2 weeks to sort of figure out while you guys were doing due diligence, are we going to go Fannie? Are we going to go Freddie? So you're right on the line. And, on this particular deal, we just couldn't risk rolling over to January, because part of the play was for a lot of your investors was taking bonus depreciation in 2020. And so, we don't want to start the relationship off on a bad track. So we were able to, on this transaction and the other one, get about 75% loan to value. And then I think 2 to 3 years, I think 3 years on Monterey, 2 years on this one in terms of IO. And then the rate on this last one was sort of low threes at a fixed rate with a 7-year yield maintenance on a 10-year fix. Is that right?
Yeah, we wanted to, obviously Fannie didn't really have a robust floater type product. So, what we were giving up was some of the flexibility of a floating rate that diminishes the yield maintenance. So honestly, if James was not involved, we would have probably been convinced to go with a bridge float product. And James called me and said, listen, you can do that, but you need to be aware of these issues. And he just went down the issues. And after that phone call, I had a call with the partners and said, guys, we need to get off this. We need to go to Fannie. We need to try to do a 10-7, limit the downside we can from yield maintenance. And that's the 7 part of the 10-7, and not entertain the idea of a bridge, because bridges are fine. They're great products, but there is inherent risk that you have with a bridge lender that you don't have with an agency lender.
All right, Jeremy, yada, yada, yada. James is the best. Keep going.
Well, the one thing that I want to say on that piece is that it's very rare to have a salesperson or loan originator to tell you to take less loan proceeds, right? That's like telling, very rare is that, does that happen? So we had seen it in March. There was multiple transactions where people were like, oh, I don't need Fannie and Freddie. I'm going to go with this bridge lender. They're telling me 75, 80% loan to cost, lower interest rate, more IO, everything, right? And then the only problem was after March 15th, they didn't show up. You couldn't find them. They didn't call you back. They didn't show up at the closing table. And that would be the worst thing to happen, because in November and December, we didn't know, right? There really wasn't like a vaccine. We didn't really know what was going to happen. So if worse news came out, there's another wave, and then all of a sudden your bridge lender doesn't show up. You have your equity, but you don't have 75% of the money. You're in trouble. And so you guys were probably at least 200,000-300,000 deep into this deal, and we'd just be looking at each other, December 15th, saying, "Where'd our bridge lender go?"
Terrible. Hey, can I jump in here real quick? Just ask some easy blocking and tackling questions from Prasad. Maybe you can help me with this. A lot of people want to get into the multifamily business, but they look to the right, look to their left on their shoulders, and they see that maybe some people would want to invest with you. How did you guys find investors to invest in your deals?
I'm going to start, and JT, you could pick up. As I think, when you approach your investors and really walk them through on the real science behind what we're doing, right? Most of the times people tend to really show a glamorous picture. What we tend to do is we always approach an investor to talk to them about, what is multifamily investment? What are the pros of investing within multifamily? And what are the risks in investing with multifamily? I think the third part is what really gets a lot of confidence from our investors, because they know that when they come to us, we're just not giving them a great picture. We're also giving them what are the risks, inherent risks with these kind of investments. And James, again, Paul, you're going to go yada, 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 but I think James's multifamily 101 is what I use as a Bible when I talk to my investors. But that's really the essence of really talking to investors, getting them the confidence that this is the right vehicle for them to be a part of. And when you have people like JT, people like myself and Ravi to be on the team, each of us actually have really great reputation within our investor community. So that's how we were able to raise the $3.3 million for Monterey. And the good thing is, once you get those investors to really holding their hand, being transparent to them and giving them timely information, tends to really have that confidence continue, right? And I want you guys to know that out of the 43 investors that invested with us in Monterey, we had 37 of them actually come back and invest the same amount or even more in our Brittany and Heights investment.
JT, anything more to add to that?
Yeah, I think certainly how you represent yourself is certainly a big part of at least the initial sort of friends and family approach on the first few raises, where your reputation sort of precedes itself. And then what's interesting is that there's a lot of referrals from your investors. So they've got friends, and they're talking about how they just, it's sort of cool, right? If you do have enough wealth to consider alternative investments, there's a cool factor to say, hey, you know what? I'm involved in a private placement, and it's diversifying me away from being too reliant on the stock market and all of those little tidbits. And so you end up sort of growing your investor pools from your investors themselves. We had to raise $8 million on this deal. It's about $24 million between the two properties. And so that's a pretty big jump from 3 to 8. So we knew that we had to go get more money.
So I'm going to go back to Prasad one more time. In single family, you guys kind of work in silos. You kind of work by yourself. You may work with your wife or your brother-in-law on the single family side. But in multifamily, it's definitely a team atmosphere. It's almost like putting together the band. There's 4 or 5 main members that are going to be in the transaction. How do you guys divide up the duties and the jobs of ownership? And that's, a lot of people can't get their head around that. How'd you guys do that?
JT, do you want to take a stab at it? And I'll come back.
I mean, I'll start and you can finish because you did a lot of this work. So Paul, dead on right. When you think about this is a team sport all the way around. And so lots of extended team members whenever you think about your investors. A little less, but still vitally important team members of your partners that are adding credibility if you're new at this, that you can sometimes leverage and borrow, but help you when you have a relationship there. So whenever the S hits the fan in the middle of your deal, you need to have a relationship with your insurance person. You need to have a relationship with your mortgage broker. You need to have a relationship with your tax appeal guys. All of those were leveraged in our different transactions. And it's definitely required. But then let's bring it all the way into the GP team. So we've got a GP team that's 3 or 5, depending on which deal we're talking about. And how do we keep from stepping over on each other? How do we make sure that how do we keep from giving mixed signals to our property management company? Because we've got 5 decision makers and any one of them could tell them to go do something. And so it became pretty important for me and for us to say, all right, what are the roles and responsibilities that we will have as a team, and what will be our operating rhythm to sort of keep on task, knowing that, I may have to go out when we can travel again and do my W-2 job, or Prasad may go to India to see some of his family for 2 weeks, that we can cover for each other, but at the same time, make sure that we can focus on our particular role, knowing that there's backup to allow us to divide and conquer. And then Prasad has done a great job of actually articulating that vision into a document that we use.
So can I mention some of the things here on this document? Because it's by far the most detail I've seen in an operating agreement, if you don't mind me sharing.
Sure.
Because what's funny is an investor yesterday asked me this question. They said, James, when do deals go bad, or deals that have gone bad, why did they go bad? And almost without exception, the first thing I say is there was a breakup in the partnership or a misunderstanding in the partnership. And that usually is the first thing. So that happens, then the market hits, then the property goes down, then they have to sell at a loss, right? So I think this is hugely important. And so you guys think of it as sort of like an Excel chart, and some of the items you have on here are, asset management, CapEx, investor communication, design, digital website, finance and accounting, insurance, resident experience, marketing, sourcing new deals, raising equity, securing the loan, tax protest, cost segregation. So you basically taken all the things that a GP needs to do. And not only have you identified one person, you have a backup. So you have a primary, secondary, and tertiary, so that if somebody is out of town or has a health issue, there's a backup there. And what I found super refreshing is that I did not receive a call from 5 guys every time there was news to deliver on a loan. I called Jeremy, and Jeremy called me back, and that was it. And so a lot of sponsorship groups, everybody's doing everything, and basically that means nobody's doing anything. And so the way you guys broke it up made it a lot cleaner for me on my side. So I no doubt see that probably as an investor and from your other vendors. So that was just from my point of view, but anything else to add to there, Prasad, as you're the mastermind behind the chart?
I think first and foremost, defining that roles and responsibilities is critical, but at the same time, really having your partners understand each of their roles and really sticking to their roles is important. I think that's where the team concept really comes in. Very fortunate to be a part of the JARS team. I am, right? Now, what we do as a part of our weekly huddles is, right, based on the rules and responsibilities, we do have a set agenda every week. And each one of us actually would come give our updates, boom, 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 boom. And that's done. In doing so, what we're doing is we're keeping the secondary, we are actually the tertiary, everybody informed as to what's happening in your space, so that if you have to step back for a second, everybody knows what's exactly happening to the team. So I think that probably is what I enjoy the most within our team in terms of how do we divide and conquer anything that we do here.
I think that's a great point about dividing up the team responsibilities. When you buy a property, you spend a lot of time up front. What do you guys think in the future, or just as an example, on the Monterey property, how much actual time you think you'll be spending on these properties on a weekly basis, per individual? So Jeremy, what do you think of timing?
Yeah, it's almost a relief because of how intense it is during the actual getting to the closing. We during that process, if this is a newbie's listening, we met every single night at 9 p.m., 7 days a week, to go over what was going on. I think you just should have that expectation that during that 60-day period of time, that's really what's going to be required, and that's with a team. But then once you cross over, there is certainly some intensity for the first probably month or two of just getting everything onboarded into systems so that you can get the KPIs and take the noise out and make sure your budget is there. But then what we do as a group is we meet once a week with our property manager. That call is about 30 minutes. The regional is on there as well as the property manager to go over everything that is going on. And there's somebody that's point on that, and then if any of us can join, we do. And then as a GP team, usually at 9:00 at night, we meet once a week to go over everything that Prasad just did. Now, there's certainly is things that we have to do outside of that. Like right now, we're trying to get all of our act together for getting K1s together. And so you didn't have to really worry about that in June, but you do have to worry about that in January and February. When insurance renewal comes up, there's sort of intensity around insurance renewal. When the tax appeals coming up, there's intense. So there's each one of the different roles will have inflection points as to when there's intensity around it, but it's not usually every single week, except for the property management part. And thankfully, you have a group that actually is property managing it, and you're just making sure you're managing the manager. And so for us, I would say that there's about between the property management call and the GP call, there's about 2 hours a week that we dedicate. And then because there's primary, secondary, any one of us may then have that week, we may have anywhere from 1 to 10 hours that we have to give to that particular topic. But that's not something that has to be consistent 52 weeks out of the year. It just flares up where it naturally flares up.
I mean, my final question, and maybe it's to both of you guys. You guys are in the high technology multifamily space, and just speaking for yourself to maybe some brand new limited partners that be maybe thinking about putting money into investing in some opportunity in the future, not necessarily with you, but just advice. I mean, you guys, not only did you do one deal, let's say in Texas, you guys live in Texas, you did a deal in your in your backyard, you did the second deal and third deal in your kind of your backyard. What do you think about investors that the general partners or sponsors buy a deal here in Dallas, and then the next deal they do is in Salt Lake City, or the next deal they do is in Louisiana, and the next deal they do, and they just kind of bounce around to all these different places. Just your opinion of building relationships in one market or building relationships in two markets. When you start going 3 or 4 different markets, you can't know people. You can't know the vendors. You can't know the tenants and the rules and everything that's associated with that. Any feedback for help for, limited partners thinking about investing with groups that are all over the place?
Prasad, why don't you start and then I'll finish it, because we have definitely have views on this and we've talked about it as a group.
Yes, we did. I think as a group, it is important, Paul, like you said, right, relationships is what gets us going in this business. So for that reason, as a sponsorship team, when we came up with some kind of set rules for our teams as when we go for deal hunting, what are the fundamental things that we want to focus on? And one of the things that we've done is we focused on Dallas Metroplex market. Actually, as you know, it's huge, right? If you go all the way from DC all the way to Fort Worth, that itself, the landscape is humongous. So we wanted to focus on Dallas Metroplex so that the relationship that we formed could be actually coming to help us. When it comes to really limited partners graduating into a general partners and really thinking about multiple markets, I think it's important that the team that you form, if your vision is to actually concentrate on multiple markets, pivot on what markets that you want to really go after. Make sure that one of your sponsors is boots on the ground in that market so that, he could do a lot of legwork for you, he or she, right? For us, the reason our team is so strong and we feel so much pride about it is because all of us are here in Metroplex and we can actually really go attend something at the property or actually go meet somebody in person without really breaking a sweat. JT.
Yeah, I would add, so I'll take some Michael Beckerisms here. I've lived in Dallas my whole life. I know where the hood is. I don't know where the hood is in Atlanta. So if I'm going to do deals in Atlanta, then I better have somebody that knows where the hood is. And so that's probably more than anything else, just that sub-market familiarity is probably a really important thing for an LP to try to understand, because the deals on paper, whenever you're getting them or looking at a webinar, they all look great. And you can make a great story about deals in markets that you don't know much about. It's just very easy to do that in a marketing spiel. So I think track record, besides the fact that you need to figure out however you measure integrity. And that's sometimes very tricky if you don't know the sponsor real well. But I think that, my view is that with our investors, we communicate a whole lot. I write big, huge write-ups to our investors on the 25th of every month in their inbox without fail. And not only is it all the financials and everything else transparent, I'm going into my views on multifamily. And that's establishing some credibility. And I'll be the first to tell somebody is that I just don't know enough about some of these markets. I know Jacksonville is a great place to invest. I know Charlotte's a great place to invest because of the metrics that I see in my day job. But with the million, give or take, units in DFW, a lot of workforce housing, there's really no need for me to leave Texas, which is probably the best state economy, the most landlord-friendly state, and very, very tax and business friendly. So there's just not a lot of reason, and we live here, there's not a lot of reason for us to delve out. But that doesn't mean that there aren't great deals in Phoenix or in Jacksonville. There probably are. I just highly recommend that if you're an LP thinking about investing in one of those deals, that you really try to make sure that sponsor has really strong feet on the ground or relationships there, rather than they just sort of randomly found a deal and you don't know if it's in the hood or not.
James, take us home, please.
All right, I got 2 questions to wrap us up. I would say the first question is, it is very difficult going from 0 to 1, but it's also a lot of people get stuck at 1. And so what is your advice for people? They've bought 1 deal maybe, and now they're trying to grow it to 5, 6, 7 deals. So that's question number 1. Question number 2 is, at what point or how do you evaluate leaving your corporate job and doing this full time?
Sure. I think first of all, persistence, right? When you are on to do something, the goal should be, I'm going to continue to pursue my next property and the next property, and don't give up, right? Even during the COVID times, I want you guys to know, I'm going to give you some numbers here. We've actually looked at about 30 properties. We've toured about 13 properties. We've underwritten about 6 of them. and we were best and final on 2 deals, and we got 1, right? So if you look into from a outside view, somebody who's looking at 30 deals and nothing has materialized in about 3 or 4 months' time, they tend to give up. I think as a team, we encourage each other, we keep each other motivated that we can actually go, deal after deal till we hit what is actually a good spot. 1 for us as sponsors, and 2 is for our investors, right? It is very easy to get into a deal, but it is equally important to perform on that deal and really deliver on what you actually have on your pro forma. Sure. So that is important. Now we're already looking at our 3rd deal, or the 4th deal, actually, if you count the portfolio as 2 deals. We have the same, checklist that we are going through to actually to go into where we want to go for our 4th deal, right? So keeping focused and persistent is extremely important, first thing. Second thing, leaving a corporate job to focus on real estate. I think first and foremost, I am a huge fan of the job that I have. I love what I do on a day-to-day basis. There's not been a day in my 22-year career that I went home thinking, why am I doing this, right? So because I'm so passionate about this my W2 job, I currently don't have any plans to really focus 100% on real estate. But you know what? Future could change things, right? But at this point, I think I'm happy. I will continue the way I am doing the multifamily along with my W2 job.
Jeremy?
Yeah. So I'll start with the second question. Very individualized type of answer here. If you don't like your job, then that number of units or whatever the case may be is a lot lower in order for you to retire and start working full time on your portfolio. And let's face it, if you're smart and diligent, working full time on your portfolio should, in the long run, accelerate things for you because you just have more time to be able to invest in it. If you just don't have enough cash flow to be able to leave your corporate job, well then, building an LP or, KP, GP, whatever P you want to call it, helps to get to that point sooner rather than later from just a pure cash flow perspective. But then, and my situation is similar to Prasad's. In fact, part of the reason I was recruited over to CoreLogic is because I knew a lot about multifamily as an LP investor. And so I've just really been blessed that I get to work and get paid well in the industry that I actually like to be in if I didn't have a job. And so, maybe an answer that doesn't get talked about a whole lot on these kind of podcasts or even with the mentoring groups is, if you really like multifamily, it's a whole industry and you can actually get well-paying jobs in it and end up having some of the side benefits of getting to know key people, whether it's owners or vendors or whomever, even the thought leaders in the space, while you're still working. So if you have a dead end job, consider maybe moving into the industry, the multifamily industry in some form or another. And that actually is going to help you on your own credibility as you do your own deals. So a lot of different ways to go about that answer.
Jeremy, who told you that wise piece of advice?
Well, I don't know. You and I probably came up with it together at some point.
That's right. I mean, I think we were talking about it and you were like, well, look, I have a lot of different options here and, I can stay at Wells Fargo and be well paid, but it's like every day, do I want to get up and do this and then basically take that hat off when I go home at the end of the night and put on my multifamily hat and work on deals and underwrite deals? Or do I want to be part of an industry and where everything that I do essentially makes me a better investor, right? So everything that you do at your job, whether it's with rent collection, whether it's screening tenants, all that stuff improves your role as a investor, as a general partner, as a limited partner.
I think it's well said. Yeah, it's definitely true. And it's very rewarding to do it that way. And you also, as you build that wealth, to Prasad's point, that wealth that you've earned creates options for you. And you don't necessarily have options if you don't have the wealth that can sustain you should something bad happen, should your division get sold and your job gets eliminated, those kinds of things that you just don't have no control over. There's some insulation that happens whenever you've done this for a while because the returns are great. Not guaranteed by any means, but the returns have been, they've served me well since 2015.
So I can sit here and talk to Prasad and Jeremy all day, but some period of time we have to call it a day. So James, any final words to add?
No, I mean, what is the best way for people to reach out to you guys? Maybe Jeremy start, then we'll go with Prasad, and then I'll wrap it up.
Yeah, I mean, Prasad and I talked about this. Probably just the simplest way to reach out to us is to email us at info@jarspartners.com. So that's JARS partners.com, info@jarspartners.com. That comes to all of us, and then we can triage it from there rather than give you a big list of emails and cell numbers. But, we're the kind of guys that, just like you guys, that really could waste all day talking about this, and if you want to call it wasting. So happy to have a conversation about any aspect of this, or we didn't really even get into the resident experience part, which is a big part of our passion to take care of residents. That's good business to take care of residents, as well as the charity part. But that's a big part of how we operate as well.
Well, I appreciate you guys coming on, and Jeremy, you were probably one of the first people that I met way back when I started looking into multifamily. So I appreciate all the support and all the introductions you've made on your end as well, because I probably wouldn't be here either without you and the people and the organizations you introduced as well. So thank you for coming on, and appreciate you hanging in there and coming along for the ride, and hopefully the next time you guys are on, you've got 10 properties and you guys are killing it. So there will be a round 2. So I appreciate you guys coming on.
That's great. Success has many fathers. It looks like GE Capital was the success pathway to these guys. And through their journey, they've done a great job. So again, if you do have any questions, make sure you reach out to either Prasad or JT just to get more information about what they're doing. So we certainly do enjoy listening to the conversations, and thanks for being on the podcast. Certainly learned a lot from you guys. Again, James Zhang, the professor, thank you. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.